Hello and welcome to the Good, Bad and Ugly weekly review for the week ended 20th December, and the year end is not looking good. The market's giving up almost all the gains of October and November and looking bleak at this point. From our research desk this week, we had all these wonderful stories about liquidity, about how to deal with stock market's unpredictability, how concentration risk can hurt you, uh, then indices as momentum portfolios, survivorship bias affecting your performance, gold competing in USD as well, buy and hold era having gone past, quality narrative is trapping people, and how to know if cheap or expensive is any stock. In weekend investing specials that we do on Sundays, we have this top 0.1% have this mindset for the market. So it is about mind and behavior towards the market that we'll do on this Sunday. Please read the disclaimer and subscribe to this channel if you haven't so far. So on an hourly chart, we can see that this week has been just single way down. We were at 24,800 or around at the start of the week, and now we are sitting at 23,600. So a good 1,200 points odd given up, 4.77% gone this week. 200 DMA has been breached once again, and market is looking again reasonably oversold. Whether it will stop here or it will take this support or go further down, we'll have to see, but it is not looking very nice at this point. On the weekly chart, we are yet to break this previous support, so there is hope on that front that we may find support again near the June election day high top, like we did in November, and that is the focus point for most chartists right now. US markets are also falling 2.4% this week, despite Fed cutting 0.25% rates. They have given a forecast of 2 rate cuts for 2025. The market was expecting 4. So it seems that inflation is not coming under control. Interest rates will not be cut as much as markets expected, and hence this knee-jerk reaction is happening all over the world. Gold is also off 0.5% this week. It's not damaged as much because the USD INR has also weakened and gone to about $85, 85 rupees to a dollar. The main culprit for all global outflows from emerging markets and precious metals is the dollar index itself. Dollar index is at 108, which is almost a 2 year or 2.5 year high, and it is looking very, very strong. The new president wants the dollar to not be so strong, but everything else is already dropping against the dollar before his takeover of the Oval Office. So it's going to be a battle of currencies as the US tries to cut its fiscal deficit, tries to cut uh, government expenditure, but let's see where that goes. In benchmark indices overview, this week you had Nifty Next 50 really taking it on the chin, minus 5.84%. Nifty already I've told you 4.7%. Nifty 500 down 4.4%. Mid caps down 3.2% only. And small caps virtually have not fallen this week. That is the highlight of the week, that small caps, at least as of yet, have not fallen much. And that is quite a saving grace. In the last 1 month, Nifty small caps are actually up 9.5%. Uh, Mid caps are up 3.9%, and others are virtually flat. If we see the last 1 year gone by, you can see that still 11.5% on Nifty, 18.9 on Nifty 500, mid caps 29%, small caps 34%, and Nifty Next 50 at 35%. All present a very, very healthy picture for the last 1 year. And whenever you have a very nice 1 or 2 or 3 years in the past, you will get some corrections in the market as we are witnessing now. So in terms of Nifty sectors, you can see that uh, on a 1 week basis, public sector enterprise, central public sector enterprise, metals, PSU banks, these were the most hit, along with commodities and energy, all 6 to 7% down. Energy stocks down, infra down, banks down, financial services down. Only thing that was up was pharma at 1.6%, and lesser hit were FMCG and real estate this week. In the month gone by, again, you will see Real estate, IT, pharma, services sector, PSU banks, infra, these have been still spared from the massive falls. And energy, auto, central PSCs, media, commodities, and public sector enterprise stocks are the ones which have been taking the major brunt. In the last 1 year, only the media sector is down. Otherwise, all sectors are up. Private banks, I would say, have been the most weak among the green sectors, 0.5% only. FMCG at 1.8% only, and energy sectors at 8.6. These have been the single digit gainers for this year, but real estate, pharma, and central PSCs taking the major chunk of the gains. Again, in terms of sectoral momentum, also if we see, you can see that pharma, IT, and realty have ruled the tables in terms of momentum score for all across the year, and that is sort of the space where you should be looking for trades, as this is the where the momentum exists right now. In terms of FII DI stats, FII continue to sell. All days this week have been selling days. DIIs almost all days buying days, so no change in the stance by FIIs or DIIs. Strongest stocks, despite these down moves, you still had some green stocks. So five-star business finance at 18%, GIC at 16%, KFinTech 15%, Newgen, Techno, GET&D, Anantraj, Action Construction, Keynes, and Dr. Reddy's 7% to 18% gains in CNX 500 stocks. And the worst hit, Angel One, Deepak Fertilizer, Adani Green, LTI, Siemens, Piramal, Godfrey, RBL, Torrent Power, and L&T Tech. So these were the worst hit. I would say in a week's time, in a bad market, the worst hit is for 14.9%. It is not so bad actually. So given the backdrop of the market, I think another few percentage points and we may go into a deep sleep at the end of this year. I don't think the FIs will continue to press big sales in the last week of the year. What will be key will be January, where we will see US presidential narratives, what kind of tariffs can be put on India, budget run-up narratives, and FII allocations to India. All those kind of things will melt up together along with the end of the quarter results, December ending results. So January is going to be extremely data heavy. But for now, I think if we find some place in the next few percentage points to find an equilibrium and stay here, I think that's the best that we can hope for at this stage. Thank you so much for watching. I'll see you in the next one. Thanks. Bye.